my favorite 1, 2, 3-step trading strategy. Now, some people, some traders, now I've been teaching for a very, very, very long time. In fact, I think I'm just going into 15 years of teaching now. And over this time, most new traders and many, many, many experienced traders have very complex, complicated trading systems. Okay. Some of them are so involved. I remember once a student sent me one of his charts to help. He wanted me to help him analyze what was going wrong with his trades. It looked like a roadmap of London. There were so many lines and so many things going on. I couldn't even figure out one from the other. And he had color keys and he had initials and he had little markers. Think about it. Trading is about finding an asset that might move in your favor and the point in which you'd want to enter the market and the point you want to exit the market. Somebody once told me a very profound statement. When you're looking at your charts, when you're looking at the market, when you have no open trades, you're just somebody sitting in the bleachers, sitting on the sideline. When you open your trade, is you stepped into the ballpark. But the minute you do that, what does opening a trade do? It only puts you at risk. Every trade puts you at risk. You only make profit when you exit the markets because you have no profit while price is moving up and down. You can run and try to hit your button and close out a trade, but until that trade is closed, you got no profit. So you're either sidelined, taking on risk, or getting rid of the risk and taking on profit. So what is the most important steps in all that? Getting in the game and getting out of the game. And the only time you have profits when you get out of the game. So most people don't spend their time looking at exit strategies. They spend their time trying to get alerts and jump in the market. It's more important to sit on the sidelines or on the bleachers, or more important, to exit the market. How many times you've seen a basketball game down to the last second, and a three-pointer goes in and the game changes? A grand slam home run in the ninth inning. A last-minute quarterback, a last-minute, offside kick, and before you know it, the opposing team is now the winners. Okay. Now, there are probably as many trading strategies as there are traders out there, but not all trading strategies and trading plans are created equal. I suggest that you find some strategies and then build a trading plan around them. Now, there's a plethora of trading strategies available to you, but I will also encourage you to create your own trading strategy. No matter how good the strategy is, no matter how good this guru out there is trying to teach you his strategy, no matter how much I try to teach you one of the ones I use, there's no way I could get the wealth of knowledge or all the information out of my head and into your head. I could talk to you for weeks because I can give you an outline, but I can't give you the thought processes that go on in my head because those thought processes are different continuously. And there's always going to be, if you try to get a set of written rules that somebody else has written and follow them, you're making a big mistake. So when you build and test your own strategy, you are the master and you understand all the ins and outs, and you are not just trying to duplicate someone else's thoughts. Now, I always encourage traders to develop their own trading strategy, time permitting. Now, a strategy doesn't have to be complicated. It can be very simple, and you can continually modify, add on, subtract your strategy. You can have many strategies. Strategies are different than setups, and strategies are also different than plans. Okay. Now, creating strategy requires a trader to develop a greater knowledge of the market and its price movement. When one develops their own trading strategy, they are finely tuned into how that strategy actually works and what will cause it not to work. And they will be in a much better place to adjust it when needed. Now, now, I started trading a long time ago when we used to use index cards and file boxes. And if you see behind my desk, there's many, many of those old metal file boxes packed full of my note cards and everything else. Most of the stuff today, my stuff today is on my computer. And today you're lucky. You can build your strategies right in Word or in Excel, however you want to do them, and constantly easily modify them. And then you can reference them and get back and forth to them quite easily. Back in the old days when we would write things down on cards or paper binders. Oh, those little black and white binders. I used to have so many of them. Today it's relatively easy. But even if you trade someone else's strategy, and there's lots of people out there promoting their strategies, test it thoroughly. And in the process, you can make it your own. You can tweak it this way, tweak it that way, and learn the ins and outs and possibly add your own twist. Now, it sounds like it's a really time consuming part, but it can be fun. For me, trading is not all that much fun. Building my strategies and seeing they work and say, I outsmarted the market. Look at that, it works. To me, that's fun. Okay. And I would rather, in between my trades and when I don't do many trades a week. I only trade a couple of times a week. Okay. I'm spending my time doing research. I'm spending my time building my strategies, spending my time testing out strategies. It's just because that's where my enjoyment is. Because we have to test an idea. So the question is, how do you generate ideas for trading? Because I don't want to make this complicated for you. I don't want to make it time consuming. Okay. I just want you to put your thoughts together. So one of the easiest ways to start building a strategy is to look at an asset you've traded recently, or look at an asset you followed recently, and look where there was an opportunity, not maybe yesterday, maybe last week, maybe last month, that you didn't take advantage of, that you didn't see, that happened, and you didn't capitalize on it. And say to yourself, what could I have done, or how could I have seen this on my chart? How could have I spotted that? Okay. And then when you start coming up with ways that you might spot it next time, you start developing a strategy. Now, there's a lot of you guys out there that are very, very smart. You have excellent careers, you have excellent jobs, you have huge IQs. But really, trading isn't about smart. Trading is about organization. It's about seeing opportunities, about seizing those opportunities. And organization can be the best thing you can do. Because building your strategy requires you to write it down. And what happens is when you write things down and try to plan the steps and put it together in some type of a package, guess what? You start realizing, oh, I have a gap in here. I'm missing a piece here. I'm doing that. And you start now filling in this strategy so that it actually works. It's not, because trading isn't a guessing game. It's not today I'm going to do it this way, tomorrow I'm going to do it that way. So building your strategy, writing it down, and then testing it and creating it. And I'm not saying write every little innuendo down, but maybe when this happens and that happens, or you can do this and that, you're going to look at this next. Okay, whatever you want to do, make it simple. You can use Excel charts with little arrows and everything else, and a flow chart, but don't make it complicated. And this is one of the reasons that you want to keep your strategy simple. If you're going to write it all down and put all the notes in between and follow it to it precisely, well, you better keep it simple, because otherwise you're going to have a novel at the end. Now, keep in mind, not all trading advice is good. Figure out where the advice has come from and how much you trust the source. This is particularly important when using the internet. There are a lot of amateurs out here who think they know what they're doing, and they're just, today some guy who, I tell you, I won't tell you where, but I just saw that somebody was hired as a financial analyst for a big company. And I went to look up his resume and his background, and it said he was a personal trainer, not a financial service trainer. He was a gym trainer who liked to trade on the side. And now he's a financial analyst for a company. Well, this guy's got 92 days of experience. But now he's going to start writing articles through this company, putting them out there. And we all, not just you all, we all are going to think he's a guru and that he knows more than we do. So always find out where your information's coming from and then test and modify it. So when you develop your own trading strategy, you'll start with a set of recommendations from analysts or other traders. So saying use everything that's out there, but remember they're just tools. But try these out on your demo account, modify them as you see what happens. It's important to create your own formula, as this will improve your trading skills. But don't reinvent the wheel. Now I'm telling you all this because I'm going to take you over shortly and show you my 1, 2, 3 strategy. But it's simple. But I don't want you to just say, oh, Barry taught me that tonight, I'm going to go trade it tomorrow. I can only teach you a real basic set of rules that will get you from A down to X or down to A, B, C, D, E maybe. And I need you to fill in the blanks and make it your own. Now, I know a lot of technicians out there, a lot of traders are going to say, I don't pay any attention to fundamental analysis. Well, I myself don't at all, but I always look at the financial headlines. I'm always looking at the economics calendar. Why? I'm not looking for clues to make a trade. I'm looking at them to keep me out of trouble. For instance, if I forgot the Federal Reserve was meeting today at 3:30 and they might announce a rate increase, and I was about to trade the dollar against something or maybe gold, and everything on the charts told me it was just perfect to take this trade, and I forgot that 3:30 the announcement would come out. Well, before that announcement, after that announcement, no matter what it is, even if it's exactly what the market expects, the asset's going to be erratic. And that's going to increase my risk. Well, what I'm going to say is, okay, I've got this perfect setup. I'm either going to trade now and make sure I'm closing out of that market by 3:30, or I got to wait till 4 o'clock to make my trade because I'm not making a news trade. I don't want to have the excess volatility because I haven't calculated that into my loss or my risk factors. Now, there is not one strategy for everything. Decide what you want to accomplish. Do you want a strategy for entries? Do you want a strategy for exits? Do you just want alerts? Okay, alerts are important. Signals. Something that's going to hit you on the back of the head, not some robotic alert that's coming to you from some broker. Something you see on the charts is going to hit you on the back of the head when these 3 things happen on the charts and say, oh, Barry, here's a trading opportunity. So the first step in technical analysis must be the identification of a market with which the trader is interacting. After that, he must determine the time period he will enter the trade, what kind of charts he wants to use, if his trade is short term, whether you're going to use trend lines, oscillators, visual identification. Figure out who you are, what you are comfortable with. Like, even though I teach you all about technical indicators, first of all, if you come to any of my other classes, first of all, I don't like the word technical analysis. Technical analysis to me should be called chart analysis. All it is we're analyzing price movement on our charts using certain tools. Okay. Now, there are tools that we can use that are directly related to price movement, and there's tools that we use that can be used through mathematical or scientific calculations. Most of those become technical indicators or oscillators. It's not that I don't advocate for them. I'm a price action trader. Okay, and tonight we're going to be looking at that because I trade from price action support and resistance, chart patterns, volume, and a couple indicators with my candlesticks. That is it. Okay. Now, if you remember that indicators only indicate, they're like the interpreters of the market. But based on criteria discussed in our previous slide, we must pick the appropriate technical tools for the chart we examine. If the market is trending, there's little point in using RSI. If it's ranging, the moving averages are unlikely to be much use. The underlying currency pair is strongly cyclical. The commodities channel index could be a good choice. Okay. So figure out what indicators, if you're going to use them, or what technical analysis is going to fit that asset and that type of market. Okay. You should be aware that if you're looking at a trending market, you should turn off these things and turn on these things. And that should be in your strategy. So what do I use? Tonight, our tools are going to be support and resistance, trend lines, and volume. 1, 2, 3. It's my triple strategy. Now, all of us, because we're all guests of Alvexo tonight, are short-term traders. We're trading CFDs. Now, of course, a CFD can be left open night after night after night. But I think the last time I saw an actual number, 90% of CFDs were closed within 24 hours. Okay. Because they're short-term trading contracts. They're short-term derivative products. But you can leave it open night after night after night. No, as long as you're covering your spread, I don't care. So it does have the advantages of being able to left open overnight in case the asset hasn't made the move you thought it was going to make. So regardless of what time frame you use, whether it be a 1 minute, a weekly, okay, chart, and for our case, we should be looking. I look at environmental charts, I look at short-term charts, and I look at action charts. My environmental chart is my 1 hour chart. It gives me the overall environment in which I'm making my trade. I then use my 30-minute chart to define whether I want to buy or sell, whether I want to enter this market. And I look at my 15-minute chart to determine my entry or my exit point. You can determine which ones you want also, but you should always be aware of the environment you're trading in. Okay, because maybe hypothetically, gold has been trading at 1,400, has been slowly climbing to 1,500. Okay. This is over the last 2 months, say, and this is just a made-up scenario. So gold is in a longer-term uptrend, but when you're looking at it in a shorter term, it's in a very strong downtrend. Well, if you said to me gold is trending down, and I said, gold is trending up, both of us would be completely right. We just didn't define at what periods we're looking at. Now, if I'm looking at a short-term downtrend within a longer-term uptrend, that short-term downtrend has to have a lot more effort to pull that price down if the price has been going up steadily. Now, most likely it's a medium-term retracement. But by understanding what I'm looking at environmentally, short-term, and then to trade, I'm getting a better understanding of the asset. Now, I always look at my charts with support and resistance levels. So hold on, let's pop up a live chart here. Give me 1 second here. Okay, so we're looking at my standard teaching chart. If you guys were here for last week for class, you saw this chart last week, here the week before. Okay, this is my 1 hour Euro US dollar chart. It's my favorite asset, it's my favorite chart, but this is my teaching chart. Now, if we were to look at the euro over a longer term, we can see for the last 2 weeks, okay, it's been in an overall downward movement. That means the pressure is down. But we could see here, if we were just looking at the short term, we could see here that it possibly had an uptrend. If we were looking at it in this period, it possibly had an uptrend. So if we were to change our charts, let me just get my marker off here because I do a 30-minute chart. We might see something different. Now, my support and resistance lines stayed right there. And they gave us a more defined outlook of what was going on with price. Look at how price has been hugging this critical price level right there. 1065 has been very, very structurally important. That's just a side comment. If we were to drop this down to a 15-minute chart, actually the euro looks pretty much the same for all three time frames. Means I wouldn't be trading the euro at the moment. But now look at that in a 5-minute. Okay. We see that in a 5-minute chart, price has been cascading down. This is the chart you would be using to make an entry point or find an entry price level in which you wanted to enter the market. Okay. But it's not where you would make your decision to make a trade. You would have made your decision to make a trade if there was a trade opportunity in your 30-minute chart. So we looked at our 1 hour that was our environmental, a 30-minute chart that gave us our possibly trading signal. And then we would look at our 15 or 5-minute chart to get an entry point. There's nothing really, we just have some sideways congestion at the moment. But this is why your support and resistance levels are so critical. Now, I also then combine this with trend lines to make my trading strategy work better. Now, I don't use a trend line based on we have rule-based trend lines. And rule-based trend lines are very, very important. But when I'm looking at my trend lines for a trade, I don't have the rule base that it couldn't have dropped below and moved above. It couldn't have broken the trend line. I'm looking to define the movement of the asset. So we could call it an overall trend, or we could just call it a trend line. And then once I start making my final decision, I always want to look at volume. Volume is no matter really whatever trading strategy you use, volume is your final supporting piece of information. Do the other traders out there support the movement of that asset? Now, I know a lot of you, and every time I talk about volume, I get these same comments in there. Okay. Volume started when we started having this, say the Chicago Board of Exchange, we had commodities trading, we had the New York Stock Exchange or any stock exchange, because in these cases, volume is reported by the exchanges. So we always know up to the minute what volume is. We know exactly how many shares of Google have traded hands in the last half hour. When we're trading CFDs or we're trading non-exchange items like Forex, there is no volume. There's no exchange. Cryptocurrencies, there's no actual exchange, global exchange. So the way analysts have put or interpret volume on your charts is the volume is the volume traded through the major liquidity providers. And that volume is equated to what the global volume would be. Because since these liquidity providers are providing liquidity all over the globe, and that number they're coming up with, if there's a big jump in their volume and it's in your charts, if you extrapolate it out, it would equal the overall movement of the asset, globally, say. So we can still get a relative piece of important information from the volume. Now, if you're trading with small unknown brokers, or you're trading with unregulated brokers, this becomes a little bit weird. Okay. The reason being is the data feeds to charts are very, 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 very expensive. Okay. And the accuracy of your charts are very important. When you're trading with a regulated broker, they're using the standardized data feeds because the regulators require them to. They're also large enough and there's enough volume, enough trading going through their situation that this fee isn't that critical to them. Where when you're dealing with a small broker or a non-regulated broker, you have no idea if they're getting the primary data feeds, which is the data feeds coming directly from the regulator, from the exchange, or they're getting data feeds from a liquidity provider, or they're getting data feeds, a secondary data feed. Okay, and this is a critically important thing. So always make sure you trade with a well-known regulated broker, because the speed of the data determines the cost to the charts. Like if you want data that's 15 minutes old, now no broker provides it, but back when I started my education center and I needed charts for teaching from, since I wasn't providing any training, I didn't need them up to the second. Well, if you want 15-minute-old data on your charts, guess what? The feeds are virtually free. It's the amount of costs the charts have, the chart providers and the data feed providers have. I don't know all the technical stuff. That costs them so much to push that data on a regular basis out to that quickly. So, but the volume can be extrapolated to represent the global markets. So for my strategy, you need 3 pieces of information. Price movement, well, it's three pieces of it, but you need to look at 4 things. First of all, it's price movement on the charts. Then we look at support and resistance levels. We look at the overall trend. We look at volume. We've also looked at our environmental charts, our alert charts, and our entry point charts. Okay. Now, when you start writing all that down, it sounds very confusing. We're going back and forth. But when you start writing it down and putting it in order and explaining to yourself step by step what you're going to do, you're starting to build yourself a strategy. So tonight's class, I can't spend the time, we're running out of time anyway, but I can't spend the time teaching about support and resistance. Just last week, we had a whole 1-hour class on just learning how to put support and resistance on your charts. Okay. You need to become an expert at that because that's what makes you a better trader than the guy sitting next to you. But you want to look for a series of low points where price did not fall below or any farther. This is your support level. Look for a series of high points where price does not rise above, and that's your resistance level. The more price bounces off the support and resistance level, the stronger these levels become. So the next time price comes to that level, expect it to bounce again like it did before. Okay. Now, once you've got all of these levels, or you've been drawing these levels on your charts over a long period of time, you'll find they're just on your charts. It won't let me turn off my arrow. There we go. Okay. So once a support level is identified, draw a horizontal support line and wait for the price to fall back below that line. So what we want to look for is easy to see. We want to see as price moves up and down between these support and resistance levels that were already on our charts. You don't draw charts, support and resistance levels on your charts to fit a trade. Okay. They're no different than when you were looking at my euro units. Some of those lines have been on there for 2 and 3 years. Some of those lines are only 6 months old. But you don't draw the lines on to fit today's trading. That's faking it. But once you see the price movement, and you'd be surprised how often you will be able to identify strategic support and resistance levels that price has been reacting to. Look, we could isolate price from this point, actually from this point on, all the way to here, trading in a very small box. And we could say that we have a critical price level here and here. So we could say every time price bounces off of this level, falls back to that price, it's going to rise back up to that price, come back down to that price, rise back off of that price. Okay. We could then trade the movement between these prices. Now, the fact is we don't want to trade at the resistance level or at the support level. We want to wait for price to come down to a resistance level or support level, whichever you want to call them, a price level. And if it breaks through, okay, we're not entering a trade. When it comes back up there and then is supported and it continues up, we would enter a trade at this point. We would look to exit at that point. So if it went up farther, maybe we would have sold out part of our stuff and let it roll up farther. But we would wait for it to break that line, bounce off and break it before we trade it again. And we could have gotten a lot of trades in. Okay. But here we're only coming up with our environmental. Lastly, we need to have our support confirming it. And then we need to look at a shorter term to see if we can get an entry point that would be worthwhile entering. But we also have to calculate our risk management because maybe there wasn't enough potential between this line and this price between 106.559 and 106.8 to make it worthwhile making the trade. So remember, we're sitting on the sidelines now. Do we want to, and is there anything enticing about entering a trade when we're entering risk? So hold on, let me. So many traders consider price action have special relevance when identifying support and resistance for one very compelling reason. The market has actually traded this asset at those price levels. Now, this example chart looks very much like the live euro US dollar chart we were just looking at. This guy, I don't know how many years ago I put this on. And remember, the more times that prices hit that level and reacted to that level, the more crucial and important that level is. So which elements of support and resistance work best? Well, it depends on your strategy. None of the support and resistance levels have any predictive behavior. Each is simply a probability that we won't be able to determine until the trade is over. But these levels can help traders build their approach to work with those probabilities. Okay. Imagine steps on a ladder going up the ladder and down the ladder. Each one of those steps were crucially important. But which step will the guy who's painting on the ladder miss and fall down? Or maybe he's painting inside the house. How many steps is he going to go down before he's got to climb up the steps to get around the window? And how many steps is he going to go down before he climbs? And is he going to climb down 2? Is he going to climb down 3? Is he going to climb back up 2? And then when's he going to get tired and take his lunch break? Or when's he going to smoke a cigarette? So we need some underlying piece of information. And we can get those from looking at the candlestick patterns. Now, I'm only looking for indecision and I'm looking for candlesticks that oppose each other when they're at support and resistance levels. So remember, we have entry trades and entry points and exit points. Okay. But there are many ways that you can decide to get into a trade. But after you determine a set of rules that would allow you to enter the market to make a potential earning, look to those same examples and see what your risk would have been. Determine what stops will need to be on future trades in order to capture potential earnings without being stopped out. So determine and check. Track, use your trading strategy as you build it on a demo platform. Check it out, add to it, subtract from it, and notice when it was worked well and notice when it worked poorly. Notice what opportunities you missed and how can you fine tune this strategy to not miss those opportunities. And then look for the times it was wrong and how do I get those out? Maybe you want to add an indicator. Maybe you want to add on MACD or something else to help as a final filter. And also keep in mind that no strategy works forever. Many strategies don't last forever. They fall in and out of profitability, and that is why one should take full advantage of when one still works. If something has worked for the past few months and over the course of the last few decades, it will probably work tomorrow. But sometimes the markets shift and they don't do what they did last year. So you either have to accommodate your strategy or find a new strategy. So the bottom line is strategies fall in and out of favor over different time frames. Occasional changes will need to be made to accommodate the current market and our personal situation. Create your own strategy and use someone else's and test it on a time frame that suits your preference. By using what the past has shown us, we can give ourselves some great starting points to achieve our goals. Now, if you do have any questions, I'll give you a few minutes to type them in. I can't answer. We have several hundred people here. But I promise you, every question you type in, someone will send you an answer by email tomorrow from our financial analyst department, because we always want to make sure at Avexa that all your questions are always answered. So thank you very much. And I'm going to answer this one out because it's actually insulting. Is it possible to get the slides? No. I worked very hard on my PowerPoint presentation and my slides. As I told you earlier, if you want to see a recorded version of this presentation, you can do so tomorrow by using the same link you used to come to the class tonight. Okay, from that, after tomorrow, it'll just be a recorded version of what you saw tonight. So you're welcome to go watch that at all. And then in a week or two, it'll probably be up on our YouTube station. And David says, no, the same link is not working. What are you talking about? Yeah, David, type in an answer. The link isn't working because you can't use it until 24 hours from now. So thank you very much, and we'll talk to you again real soon. Good luck now.